It's my privilege right now to introduce you to our CFO. I know because, of course, the CFO handles IR. More of you in the room know him than you know some of the other speakers. But Blake hasn't been with us that long, although it's been a couple of years now. Hard to keep track of time during the global pandemic. It's such an honor to work with Blake and to bring the expertise that he brought with him from Amazon. Of course, at Amazon, they lived through scale that very few companies in the history of the markets have ever lived through. And as well as they instill a discipline that is something, honestly, we at the Trade Desk have to continue to instill in our people and develop and grow as an institution, while at the same time maintaining a culture that is very different from some of the biggest companies in technology. So it takes somebody really special to bring that discipline, but at the same time adapt the style that they have to really help the Trade Desk uniquely succeed. So it's just such an honor to introduce to you Blake Grayson. Thank you.
This is it. This is what you've been waiting for, right? All day. You couldn't wait. Seriously, thank you all for taking the time. I know it's a long day for all of you, and I really appreciate it. And so I just want to say thanks. Again, I'm the CFO for the Trade Desk. I've been here for almost 3 years. I joined about 90 days before the March of 2020 pandemic. I joke with Jeff that this was not in the brochure when I was, evaluating the role. But anyways, let's just get started right away. Today, I'm going to cover 4 different areas for you. Talk a little bit about growth and profitability. We take a balanced approach at the Trade Desk. I'll run through some performance results. We'll also take a look at stacking ourselves up against other high-growth software peers, some other ad-funded companies as well. And then we'll talk about the opportunity a little bit. You've heard a lot about that today. I'll just try to put my perspective on that a little bit. Then we'll talk about investments and leverage, how we think about that at the Trade Desk, and areas that we invest in, but also how can we get operating leverage. This is not a business model where we have to choose between growth or profitability. We actually pursue both. And then finally, I'll talk a little bit about how we think about capital management, whether that's working capital, free cash flow, and then the overall health of our balance sheet. So moving first on to the growth and profitability area. So you've heard about this today. I'm really proud of our ability to grow our top-line spend throughout the history of this company. We have a 43% compound annual growth rate, or a CAGR, since 2016. We've generated over $6 billion of gross spend in the full year of 21. The thing I find interesting about this chart is by looking at it, you wouldn't notice that there was a pandemic that affected us, but it did. In Q2 of 2020, our gross spend went negative year over year. Programmatic decision spend is easy to turn down. It's easy to turn up. We did see, and the reason why you don't see any of that impact in the chart is we saw a pretty nice rebound in the second half of 2020. As advertisers became more deliberate about their advertising spend, and sometimes dealing with smaller budgets overall, they had to prioritize the spend that mattered. And so in so doing, we saw that rebound. Now, the other thing in 2020, we also had a tailwind, mostly in the second half of the year around the U.S. presidential election. And also House and Senate races that were hotly contested, and we built out a pretty good political program as well for that. From an adjusted EBITDA perspective, we've made a concerted effort on driving profitable growth. So our adjusted EBITDA, compound annual growth rate of 50% is actually a little bit higher than what you saw on the previous slide of 43% for our gross spend. And we ended 2021 with over $500 million in adjusted EBITDA. I'm proud of our ability to gain productivity as we scale. Now, I do have to caveat this a little bit because in 2020 and 2021, companies, and the Trade Desk was one of them, did have lower expenses. We were a bit more methodical about our hiring and some of our expenses during the pandemic, and so we got some extra tailwind from that. But even regardless, of that, I'm really proud of the company's focus and ability to grow, but also do so profitably and do it in a smart way. So when you combine those two things together, there's a lot of vectors that we look at in order to compare ourselves against. You all do it in this room, and you do it better than I do. But this is a group of high-growth software companies to compare ourselves against, essentially trying to get some companies with relatively similar market caps to ours, all that grew at least 20% in revenue in the full year of 2021. So, as you can see, we're delivering adjusted EBITDA margins well above the average of these high-growth software peers. This graph is a bit of an eye chart, but just stick with me for a bit. This stacks the revenue growth on top of 2021's adjusted EBITDA margin. Sometimes you'll hear about this kind of nuance referred to as the rule of 40, where if you can get a combination of your revenue growth plus your adjusted EBITDA margin of at least 40%, that's highly desirable. Now, it's obvious every company on here is either 40% or higher. So Jeff, I think, might have referred to this as the rule of 80 now. But that's changed. I like 40, but we've obviously, I think we've done well against our high growth software peers. And what we've also shown on this chart to the right is some very notable ad funded peers as well. We stack up very favorably against some of the largest companies around that are in the ad funded space as well. Now, the interesting thing about that chart that I showed that was from full year of 21 is if you look at the first half of this year, the first half of 2022, there's a bit of a profile change. We've managed the uncertainty well so far, through the first half of the year. I think it is important to note that, like I said earlier, programmatic spend can be dialed down, and up quickly. Like we saw in 2020, we can certainly be impacted by the macro environment. Sometimes I get investor questions, which because of the performance that we have up here, it's, you're not affected by the macro. Oh, we certainly are. We certainly can be. We did in 2020. It's a perfect example of it for me when I go back and talk about it. But I think the nuance is, and you'll hear us as a company talk about this quite a bit, which is that we believe we can gain share in any market, in any environment. So while there may be short-term volatility up, or down, over the long term, we think that provides us the ability to have conversations with our customers that will allow us to grab land and grab share quickly. And so I'm really happy with how we've managed through the uncertainty so far. It's still uncertain times today, but really excited about how we performed to date. From a North American international perspective, from 2019 to 2021, we've grown at a CAGR pretty similar in both regions. North America, both of these periods represents about 87% of our gross spend. International, about 13% of our spend. Most of this growth rate in here has been driven by connected television. That's probably no surprise. Both regions have connected television gross spend CAGR rates of over 100% over this period. So CTV is really what's growing the vast majority of this growth. I mean, all of our other channels are growing as well, but CTV is by and far away our largest and our fastest growing channel. Now, the thing that is interesting for those of you that, followed us for the last, portion of this year, there's been a bit of a separation. International, particularly in Europe, has felt a little bit more of a macro impact for us than other offices. And so that split that I referred to before, that 87-13, it's more like 90-10-ish, for us right now. And that's okay. I think that for us, we believe very strongly that as the international macro conditions improve, we're in a position to, like I talked about before, when conditions improve and people make more deliberate decisions, we're in a position that we like internationally. But to date, the international business is a relatively small portion for us. Now, when I talk to investors, I get a lot of questions about take rate. It comes up super frequently. So take rate's just defined as our revenue divided by our gross spend. Questions tend to focus on our ability to maintain that take rate over time as we scale. And the take rate is essentially the share of the value that we keep as a company. And questions about whether or not as we grow and as we get larger, can we maintain that? You'll see on this chart, our take rate's been very, very consistent over the past, 8 years. Our take rate's ranged very tightly around 20%-ish every single year. Another question I get on take rate usually relates around CTV. And the question is, well, can you maintain your take rate as CTV grows and share? Well, the answer is, you can see it right here. That, from when CTV spend first started showing up on our platform back in 2016, the first full year of spend, to today, where video represents it's like the low 40% share of our business. CTV makes up the majority of that. Our take rate's been relatively consistent, throughout that whole time. I think if you look at over these last 5 years here, from 2016 to 2021, our take rate's gone up 3 times. It's gone down 2 times. So, there can be short-term volatility in it, but it really just indicates the history of the performance that the take rate has been relatively consistent. And then the other thing we do is we share these numbers annually to highlight that we essentially we provide a consumer surplus. We extract we add more value than we extract. Since 2016, we've made a lot of updates to our platform. You've heard about it consistently from all the folks who've been up here today. We've created the data and the value-added services marketplace. It's got over 250 partners. We've added products that drive value, whether that's cross-device or predictive clearing. We've got unified ID. You heard about fractional pricing as well. So we've done all these things. We've launched a new platform in Solimar. We've launching new products like OpenPath that drive supply path optimization. So we do all these things, but we do them while maintaining the take rate, the value that we extract from customers. The reason we do that is we believe it spins our flywheel. If we can provide more return and more value to our customers, they'll come back, they'll spend more with us, they'll use more campaigns, and we're happy to do that if we can continue to be their partner and spin our growth. So, and after all of this, we're able to generate efficiency with how we deploy our resources. This chart shows the full year 2021 revenue and adjusted EBITDA per employee. It shows we've got a desirable model. To be fair though, again, especially in 2021, we were pretty methodical and pretty deliberate about our hiring in 2021, with regards to the uncertainty. So that played a role in both of the kind of the performance here. I mean, we'd still be, I'm still very confident in our ability, even if we were hiring at our normal rate. But I think the benefit of us doing that in the situation that we did is that we're not in a position today that, that I read about, that we all probably read about so many companies that are talking about layoffs or hiring freezes that maybe overextended themselves. It's of course, if things change, there's a number of levers we have available to us to make those kind of hard decisions. But I think those being methodical and deliberate with our investments over time has really set us up really nicely for us as we continue to grow out of the uncertainty. I'm also excited about the diversification across our business. There are some companies out there that are highly dependent on a few verticals, a few industries, things like that. We have a breadth, I think, that I really like as a CFO. Here you can see the mix of our spend and the change from it between 2019 and then 2021. I find this interesting because it's essentially what you might call as pre-pandemic, so 2019 into 2021, and seeing some post effects. So some verticals have grown. You'll see health and fitness up there has grown a bit. That's a pretty big vertical for us. It includes things like CPG products, healthcare, pharma, fitness-related activities. The one that I've highlighted on here that I find interesting is one that's actually declined in mix, and that's automotive. It's declined a bit, and that's an industry, obviously, that spends a lot on advertising. They're very active in it. Supply chain issues that started for that industry in mid of 2020 still continue to persist a bit. I'm excited about it. We've actually won business from automotive companies over the past 2 years. And when supply chain issues and the other issues resolve themselves, I'm really optimistic that this can be essentially a vertical that's still got recovery opportunity for us moving forward. I mean, I just know the pent-up demand for new vehicles is super high, and so we're really excited about that. Other metrics you probably have heard us comment. So we talk about our retention rate quite a bit. We continue to exhibit retention rates of over 95%. We've done that over 8 years in a row. We have a pretty reliable customer base that we get to work with. We work with over 1,000 active clients. We represent over 50,000 advertisers. It provides a level of scale that I'm excited about. Helps us drive more leverage and operating efficiency too as we grow. You also heard about joint business plans or joint business partnerships. They continue to increase as a percentage of spend. You've heard about this. I don't need to go into too much detail. Just multi-year endeavors with large advertisers. The main benefits is our team gets to have multi-year strategic conversations with clients, not as much the tactical, 6-month and under type conversations, or even less sometimes you have with customers. For me, from my perspective, one thing to point out, these are not like standard SaaS contracts where you amortize revenue or anything like that. They are endeavors to spend that we lock arms with our customers. We provide incentives over a host of different areas, and we deploy multi-year strategies with them. It leads to much more interesting and fruitful discussions with our customers. I think it really helps. I can hear it from Tim and Jed and other folks on the team. Our sales, account management, and client development teams really get the opportunity to have much larger, longer, term conversations with these customers, and we think that's going to spin our flywheel faster and longer because of it. So, real quick about the opportunity, and you've heard about this a lot. This slide just represents the open internet's huge. It's that section, video, audio, and display. This is about us just getting started. The entire ad industry is projected to be about $820 billion. I bet if I ask 3 of you in this room, you'll all give me different answers. So directionally, that's about how large, we think it is. But to be fair, there's some channels in here that we don't really participate in today, like search. Today, we don't really actively participate in. Now, even if you take search out, there's over $500 billion of TAM or opportunity that are remaining. Now, why we really don't participate in social, we are winning spend from them. I think that social platforms have struggled a bit. The Apple IDFA changes and such are providing opportunities for us to have conversations with advertisers about spend that they otherwise might have put to those platforms. But what I'm really excited about is how big that traditional media number is there below. The majority of that is linear television advertising. And so that's going to move to digital, and we believe it's going to mostly move to CTV. Of that, at $820 billion, you see the $250 there in linear. We've got total TV advertising spend. You see CTV there, and TTD's that tiny little slice that you can kind of barely see there. I know it barely shows up on the chart. I believe, just like Jeff does, that it's not a question of if that linear advertising spend's going to move, it's how fast. And so we all have to make decisions like, do you think it's going to go down in a very slow linear fashion, or do you think it's going to follow the streaming hours, right? Which is already such a different viewpoint for me when I look at this chart, that streaming hours are quickly becoming similar in size to linear. It's going to overtake it, in the near future. And that number, that $250 billion number doesn't even include what Samantha came up and talked about with regards to shopper marketing. Retail media alone, depending on who you ask, could be a $100 billion opportunity just in 2022. So it's just the size of the pie, the available TAM for us is so large. I actually showed a version of this to all of our employees, and it was a way to provide some reality in the situation where we are. We've been very excited about our growth to date. We should be. We should be really grateful about how well we've done. But we are really just scratching the surface of the opportunity. And so it's really just to show everyone that if we can execute and do this right, the opportunity for us is multiples larger than what we are dealing with today. So a few quick slides about investments and how we think about operating leverage. So when we look at operating expenses, excluding stock-based comp as a percentage of our revenue, and you can find all this in our filings, between 2019 and 2021, we made a concerted effort over the past few years to be really thoughtful about productivity, especially in areas that don't impact the customer experience. And so what you can see here is between those 2 years, we gained the most leverage actually in our platform operations bucket. Now, that was our largest investment area in 2019. We've reduced that materially. Predominantly, that's the infrastructure needed to run the platform. So whether it's becoming more efficient with our on-prem data centers or more efficient with third-party cloud agents and structures that we have with a number of providers, I'm really proud of the team and just the diligence that went into this. I really enjoy engaging with them on these discussions. I hope they do too. But it's something where I'm really proud of the work we've done there. And then you can also tell on this chart that we've gained leverage as well in G&A. And it's, we're still investing. It's really just a question of how fast you're growing relative to your revenue. And we still want to make sure we invest in these areas because we have to scale. Our support functions need to scale up to support the growth we need. But I'm a believer that can we do so efficiently and be able to, essentially drive leverage while we're also driving growth. And then we also track productivity in areas that we invest very hard in. Sales and marketing doesn't get a pass just because we think it's really important, right? It is important, but we also want to make sure we hold ourselves accountable to the amount of expense that we're investing. Are we getting the return for ourselves that we think is realistic? Now, this doesn't mean that we won't invest ahead if we have an opportunity available for us, but over the long term, we believe we have a very efficient model, and it stacks up pretty favorably to these high growth software peers. And then, over the long term, we believe that we can drive growth, gain share, and generate adjusted EBITDA margins of 40%. Now, in my earlier slide, some of you, if you watched closely, you might say like, wow, 40% seems like an underwhelming goal. We did a 42% EBITDA margin in the full year of 2021. Now, my answer to that would be, I agree. Only if that was the only goal we went for. In that, if it was all about adjusted EBITDA margins, if that was the one thing that mattered to us more than anything, we could optimize our business for it, and we could beat that target that we have up there on the screen. The reason why it's on there is because we're all focused about that balance between growth and profitability. And you saw that on the previous slides when I was talking about full year revenue growth and on top of the full year adjusted EBITDA margin is that we have that balance. And I think it's really important for us to be able to manage that. So, over the long term, I think we can drive profitable growth and continue to gain share. And so finally, just a couple thoughts about how we manage our capital and what the thought process that goes into that. So working capital is top of mind for me. It's top of mind for my team. It's top of mind for the company at the trade desk. In general, we pay for media in advance of receiving payments from our customers. So that creates what I refer to as a working capital gap. Our days sales outstanding is larger. It's higher than our days payable outstanding. So when you're buying billions of dollars of media in a given quarter, having a gap of, call it 15 to 25 days of a working capital gap, means there's hundreds of millions of dollars that are outstanding and float, and we have to be able to make sure that we're managing that gap well. You'll also note in the chart that there was a pretty market improvement that happened right around Q2 of 2020. When COVID hit and the uncertainty that occurred, we spent a lot of time looking at our working capital process. And by inspecting our collections and payables processes, we drove some improvements, and we've been able to maintain those, generally speaking. And it showed up in our free cash flow results. In this graph that shows trailing 12-month free cash flow, you can see that improvement that occurred in that back half of 2020 from those efforts. I mean, if you look at in 2020, our free cash flow was actually higher than our adjusted EBITDA for the year. That's pretty unique. 2021 also improved as well, but again, to be fair, we were still benefiting from the virtual environment, both in slower hiring and a bit lower than normal kind of overall, mostly employee-related expenses around that. But even regardless of those two things, we have a business model that generates strong free cash flow. It allows us to self-fund our working capital as we grow, and it also adds cash to the balance sheet. Over the last 2.5 years, we've added approximately $1 billion in cash to the balance sheet. We continue to have zero debt outstanding. We've generated positive cash flow in every one of these years, 2019, 2020, and 2021. And at scale, I would expect, all things being equal, this would continue to improve. Having the capital provides us flexibility, and we've had a number of discussions about it from a capital management perspective. And finally, just how we think about the options for capital allocation. Investing in the business in working capital is how to date we've managed that. We've deployed it that way. We're always looking to reinvest and drive growth. Managing working capital is investing in the business. That's a function of it. I would also say that having that capital in challenging times, we have more flexibility to use as leverage as we, can win more spend. As it relates to M&A is not something you hear much from us about, at all. But it might surprise you to know we have a very active M&A program at the trade desk. Valuations are down significantly. Our team's constantly looking, but we're super deliberate about it. What Jeff and I like to say is that we're very good at saying no, and we say no a lot, more than anybody knows. But what I can also say on top of that is that if it is the right choice, we wouldn't spend the time on it if it wasn't something we were actively looking at. But if it's the right choice, we'll make that choice. But we are picky, and we have the luxury, I think, to do that. And our history shows that we try to make decisions not just right for the product or our customers, but also for our culture. And so we're thinking about all those things as we consider M&A. As far as share repurchases go, that's also an option for us to consider as we evaluate that. And if we ever did one, we'd prefer to be opportunistic about it and offsetting dilution if possible. That's how, at least the way that I think about it. Dividends are also obviously an option as well, but it's likely a little bit too early, to be honest, in our company's journey for that. But these are the options that we consider and I think about all the time. And so, with that, I just want to say thank you, everybody, for sticking around. I think we're going to do a Q&A, but Chris will come up. Thanks a lot.